Hi, we're getting ready to try some problems, demonstrate some problems in Chapter 4, but before we get started, if you haven't already read Chapter 4 or watched the interactive presentation for Chapter 4 in Connect, please do so before watching this problem demonstration. I'd also like to review some concepts with regard to adjusting journal entries before we start the demonstration. Remember that the accrual basis of accounting, which you've been learning, is based on the revenue recognition and expense recognition principles. The revenue recognition principle states that we record revenues when they are earned, when goods or services are delivered, whether or not cash is received. The expense recognition principle states that we record expenses when we receive the benefit of whatever cost we've paid for. We try to match them against the revenues that they help to create, not necessarily when cash is paid. As a result, adjustments are sometimes necessary at the end of the accounting period before you prepare your financial statements to ensure that revenues and expenses are reported in the correct period and that assets and liabilities are reported at the appropriate amounts. There are two types of adjustments, deferrals and accruals. The first problem we're working on today deals with deferrals. Deferrals occur when cash is received or paid too early. For example, a business receives cash payment before they deliver goods or services, or perhaps a business is required to pay for something they will not immediately use or receive the benefit from, like insurance. The problem is that the cash doesn't correspond with the revenue being earned or expense incurred. There is an original transaction recording the cash receipt or payment, but the recording of the revenue or expense has to be delayed or deferred. In fact, defer means to delay. Then a second entry, which we call the adjusting entry, is made to record the revenue when it is finally earned or when the expense is incurred. Okay, so let's now start problem M4-9 on page 180 on the text, and you can go to Blackboard and print out the worksheets if you'd like to record answers for these problems on the worksheets I've provided. Okay, it says, for each of the following independent situations, prepare journal entries to record the initial transaction on September 30th and the adjustment required on October 31st. In A, hockey helpers paid $4,000 in cash on September 30th to rent an arena for the months of October and November, 2 months. So let's go to our journal entry here. Sorry, I've got some things in there already. So let's record the payment of $4,000 cash on September 30th to rent an arena for 2 months. We are paying out cash. Cash is an asset on the left side of the accounting equation, so we would left side our debit to increase, but we want to decrease cash because we're paying it out. So we'll credit cash. We'll do the opposite. Now what will we debit? We can't debit rent expense because we didn't receive the benefit of being in the arena for 2 months yet. This is a resource, an asset, until we've occupied that space. So right now we are going to call it a prepaid rent. Let's see, there we go, prepaid rent. And prepaid rent is an asset. Assets are on the left side of the equation, so we have a left side to debit. Once we've occupied the space at the end of October and November, then we'll take some money out of prepaid rent to represent the portion that we've used up. And that's what we're doing next. It's now October 31st, and we've used up 1 month's worth of rent. If it's $4,000 for 2 months' rent, 4,000 divided by 2 is $2,000 a month. So we need to reduce the prepaid rent account for the 1 month that we've used up. So we will credit the asset prepaid rent to take out the 1 month's worth of rent we've used up, and we'll call it rent expense. And the reason it's an expense is it's a used up benefit. Our next journal entry involves super stage shows. They received $16,000 on September 30th for seasons tickets that admit patrons to a theater event that will be held twice, once in October, once in November. Now we're making the entry on September 30th. They're receiving cash of $16,000 today before they've performed any shows. So this is an unearned revenue. They have not yet delivered the goods or services. Unearned revenue is not really a revenue, it's a liability. We owe our customers the right to see those shows. Now let's go to October 31st. And at this point, one show has been delivered. One theater event has been delivered. So we need to take one theater event out of the unearned revenue account and call it revenue because we've earned it. So $16,000 divided by 2 events is $8,000 an event. So let's debit the liability unearned revenue to reduce it by $8,000. And now let's credit service revenue because we have earned one theater event's revenue. We have held the event and consequently we've earned it. Our third set of transactions involve Risky Ventures. Risky Ventures paid $3,000 on September 30th for insurance coverages for October, November, and December, 3 months worth of insurance. Okay, and it was paid September 30th before they received the benefit of any cost. Well, if we're paying out cash, we want to reduce the asset cash. Sometimes it's easier to do the cash part of the transaction by itself. What's our debit? Well, we haven't received the benefit of that cost at all. This is a prepaid expense. We'll call this prepaid insurance, and it's an asset, an economic right or resource to be covered by that insurance. Once we've used it up, we'll take it out of prepaid rent and it will become insurance expense. And that's what we will do now on October 31st. I guess I should call it quits for tonight. Starting to get my words all mixed up. Okay, so on October 31st, we have used up 1 month's worth of insurance coverage. It was $3,000 for 3 months. We divide that. That means $1,000 a month. So we need to take $1,000 out of the asset prepaid insurance, and we credit assets to reduce them, and we'll debit insurance expense. Why? Because it's a used up benefit. We've received the benefit of the cost. So we reduce the asset and call it an expense. I'm going to record that entry and then show you all the entries together. Okay, now as we look at them, please note that the adjusting entries have some elements of the original entry. Here we debited prepaid rent, and now we're reducing it on October 31st and calling it rent expense. Here we recorded unearned revenue. A month later we reduce unearned revenue and call it regular revenue. Here we increase prepaid insurance because we didn't receive the benefit of the cost. On October 31st, we reduce prepaid insurance and call it insurance expense. Now on to our next problem. Problem 4-8 is based on the information in problem M4-7, also on page 180. This problem deals with accruals. Adjusting entries are required to record accruals because these are revenues and expenses that have not yet been recorded at all. That's because the cash is happening too late. The revenue has been earned, the expense has been incurred, but we haven't yet recorded them. So the accrual adjusting entry just records them. These are the same exact entries you learned in Chapter 3, except because they're occurring at the end of the accounting period, we call them adjusting journal entries. Okay, so let's look at our problem. For each of the following transactions for a new idea corporation, prepare the adjusting journal entries required on July 31st. Okay, on NA, we received a $600 utility bill for electricity usage in July. Okay, now it is for the month of July that we're making these journal entries. The utility usage is in July, so yeah, we should record this as an expense in July. We received the benefit of the cost, but we're not going to pay it until August. So we're not going to use cash. We'll call it an accounts payable. So our debit will be to utilities expense, and our credit will be to accounts payable for $600. In our second journal entry, it says we owed wages to 10 employees who worked 3 days at $100 a day. So we multiply 10 times 3 days times $100 a day. That means we owe $3,000 at the end of July. But the company won't pay the employees until August. So we're going to debit salaries and wages expense because we did receive the benefit of their labor during July, but we're not paying until the next month. So we'll call this perhaps salaries and wages payable. And then we'll record the payment in August when the payment is made. And our third and final journal entry is on July 1st, we loaned money to an employee who agreed to repay the loan in 1 year, along with $1,200 for 1 full year's worth of interest. No interest has been recorded yet. So what we're going to do is take that $1,200 and divide by 12 months because the loan will be repaid in 1 year, and we're going to show that we earned 1 month's worth of interest. So since we aren't going to get paid until the end of the year, we're going to debit a receivable. Instead of accounts receivable, let's debit interest receivable for $1,200 divided by 12, or $100. And let's credit interest revenue for $100. Let's record the third journal entry. And now let's look at all the journal entries. In each case, we are either debiting an expense or crediting a revenue. Every single adjusting entry either debits an expense and credits a revenue. In this case, we're recording accruals, things that have not yet been recorded. So we're also recording a payable for bills we have not yet paid, and a receivable for amounts that we have earned but not yet received. Okay, so now you can either try some practice problems, or you could go on to your homework problems. Have a good day.